morning, everyone. My name is Frank O'Brien. I am a benefits educator with Wespath Benefits and Investments, and it is my pleasure to be with all of you today for today's retirement webinar. With me from Holston is Julie Graham, and with Wespath is Cheryl Hatcher. Cheryl will be working behind the scenes, keeping the webinar going and getting us, through the morning. Some housekeeping items. Hopefully you have all received your material in the mail. There are a couple of participants I still need to reach out to for various reasons, and we'll do so if not today on Monday, but we'll certainly make sure everyone gets what they need. With those materials, the PDFs of those materials, as well as a PDF of this presentation, will be provided to Julie for posting on your website there, and then you can continue to access that information as you need it. And 5 of those materials are actually on the toolbar on the right-hand side for the go-to webinar. You can see a few of those documents there, and you can just grab them there if you like. This is going to be recorded. And what we will do is we will record this big session that's going to go through all of the retirement plans, the participant services, and those types of things. When we get done with that, there'll be a break, and then we're going to do a demo, a demonstration, and that's going to be recorded separately. So 2 recordings will be provided back to Julie probably Monday as we're getting into the weekend. We have a question box. Cheryl will be monitoring the question box. Periodically, I will try to remember to bring her in to see what kind of questions may have been provided. Certainly, Cheryl, if you see that I'm on a roll and something's come up and you want to jump in, feel free to do that. So I think that gets rid of the housekeeping items and we can move along. So what we're going to talk about today with the agenda relative to this presentation is we're going to talk about the retirement and the retirement process. We're going to go through the retirement plans, your benefits, your options, the annuity options that you'll have, the annual cost of living adjustment options that you will have. And we'll hit on all of the plans, CRSP, MPP, if anyone has pre-82, as well as the UMPIP. We're also going to talk about life stage retirement income, the program that we have within the distribution options in retirement, where you ask Wespath to derive the amount of monthly installment payments for you. And there's some program features that we will review. And we'll go through other items, the comprehensive protection plan, the housing allowance exclusion, and then participant resources that are available to you. As we get started in our presentation, we actually take more of a qualitative approach, more of an emotional type of approach in the context of the 5 dimensions of well-being that we have. So when we begin to talk about retirement, we ask ourselves, how do we feel about retiring right now? Some people may be apprehensive, some people may be excited, some people may be concerned, some may be prepared, some may feel unprepared, or something else. And I think in the context of this, all of these probably come into play at one stage or another, to some degree or another, as you're beginning to think through and make your plans for retirement, and not just your Wespath elections, but in general. There are some common thoughts about retiring. Is now the right time? Or maybe should I continue to wait? Am I ready? And readiness is not necessarily, again, the elections you're going to make for Wespath benefits, but just in the general sense of being ready for that transition into a new style of life. Not being always available and on call, but allowing yourself to actually enjoy that retirement and some of the freedom that will come with that. And with that also, is your spouse ready? Clergy are very busy individuals, a lot of time out of the household, at the church, or doing other things within ministry, and now more and more time will be spent at home. Of course, the question is, will I have enough money? We're going to hear about EY Financial Planning Services throughout this morning. Certainly getting a handle on that using your advisor or EY will make the anxiety level come down some. Where will I live may be a question for you. And what will I do with my time. There could be hobbies that you've been thinking about getting started with, photography or golf, or maybe you already do some of those things and now you will have more time to do those. When the road to retirement begins, you ask, on this road, what are you packing for that trip? What will your July 1st look like? So as we know, July 1st tends to be the retirement date. There are some exceptions along the way. So as you're thinking out about, okay, all the things you need to do, what is it going to look like once you get into early July? What is that retirement going to look like? Again, what will that July 1st look like? A little redundancy there. And what type of retirement are you looking at? So this is just kind of a broadening way of thinking about your upcoming retirement, not necessarily in the mechanics of Wespath, but obviously we will begin to get into more of the mechanics as we go through this morning. First of all, we'll talk about, well, how does the Book of Discipline view retirement? Well, we have what's known as normal retirement age, fully available for your benefits. And normal retirement is at age 65 or 40 years of service, and or is the key word there. If you are 63 and you have 40 years of service, you will retire under the normal retirement provision of the plan. And then there is early retirement. Early retirement is the attainment of age 62 or 30 years of service. We're going to visit early retirement because there are some adjustments to benefits that get paid under the early retirement provision, and we will go through that. But similar to the normal retirement, the key word is or. If you're age 60 with 30 years of service, you can retire under the early retirement provision. And there is the mandatory retirement provision at age 72. So the attainment of age 72, you then move yourself into the retirement appointment kind of like automatically. And then there is the 20-year rule. And this is for individuals who are in ministry for 20 years, whom for whatever reason have decided that they want to go on somewhere else in their ministerial career or just career in general. If they attain 20 years, they can go into the 20-year rule of retirement. However, at that point, that individual has to wait until they attain age 62 to begin to receive benefits under the early retirement provision of the plan. They can certainly wait until age 65 as well, but really at age 62 is when these benefits become available. So what do I do if I'm retiring next year? Well, we have a checklist. That checklist is probably something you've been provided in different forms. It certainly isn't the material that we're providing. It may be on the sidebar right now. And it does provide to you a roadmap to retirement. This is the visual of the checklist that you should have received, and we're covering topics in terms of what can you do right now, what should you be doing within 60 to 90 days of retirement, 30 to 60 days. So it kind of helps you, guides you through the time frames that you're under right now to be in position to receive your retirement benefits on July 1st or a little later in July. So we're going to start packing for this road to retirement trip. On this checklist, you're going to see that you want to verify all of your personal information. You want to make sure your name is spelled right, your address is spelled right, or it's correct. Date of birth, social security number. Numbers can switch and move around a little bit, 3s and 5s and 8s. So you just want to make sure that's all in good working order. But for those who are married, you also want to verify your spouse's information is correct. You're going to hear about life and survivorship annuities that will go to your spouse. You need to make sure that we have good data for that. And you also want to verify that your clergy service record is correct. You can generate this on Benefit Access. It was provided in the materials in the mail, the clergy service record. Really, that record is provided to you by Wespath in a readable, logical, sequential format so that you can go through and reconcile your ministry If you have any questions relative to those appointments that you've had and the percentages in the years, we would send you back to your annual conference to speak to Julie or whomever, and any changes that can be made on benefit access will be made, and we can update another report for you. Why is the accuracy of your clergy service record so important? Well, first and foremost, we think it is because it is a reflection of your ministry. And so, we think that that should be fully informed in and of itself. But benefits also get generated by virtue of your service record. You will see for the Clergy Retirement Security Program, we use years of service and determined timeframes as part of the calculation for your CRSPDB annuity. For those within the Comprehensive Protection Plan, there is a death benefit in retirement benefit that is also based on years of service. And I'm sure I'm forgetting about one or two other things that ties back into those years of service. So you want to make sure that for benefit designation and generation, your years are correct. You want to review and update your life stage investment management profile. Many of you may know, many of you may be in life stage investment management and not actually know. That is the program that we have where we are tailoring investment allocations for you based on a risk tolerance, your age, where you are in duration towards retirement, those types of things. So we are managing that investment allocation for you over time. Not all are in life stage investment management, certainly some do self-manage. But for those who are not sure, you can see that information and update it as you need. Project your retirement income. There is a retirement benefit projection that was provided. That benefit projection can be run by you on your own if you so choose. And how would you do that? Well, register for benefit access at benefitaccess.org. We hope that all of you have registered for benefit access. If you have not, please do so. It's a 7 to 10 minute kind of process where you just go in and identify yourself, and then we do authentication through the phone, make sure it's you, then you go back through, you set up your password, your ID, and all of those things. For those who are registered but don't use benefit access a lot, we recommend you go back through it. It changes now and again, so you want to make sure you're comfortable with what's being presented to you, the navigation of the platform, all of that, because once you get to the time where you will be making your elections, and I'll demo this later, you're making your elections, you will do that through benefit access. So you don't want to be dealing with trying to figure out benefit access at the same time you're making your election. So give yourself a little time to get more familiar with that. And it's a great tool. You can get your personal information. This is where you can check your personal information. You can check your spouse's information to make sure that is all in good working order. You can see your beneficiary designations as well, primary being your spouse or someone else, and secondary, if you have some, maybe for your children. You can look at and generate that clergy service record we talked about. You can see on BA how your life stage investment management profile is set up, and you can use our tools, including that benefit projection. So 2023 retirement benefit applications will be completed in benefit access. So I indicated before, we don't really go paper-based anymore, completely moving away from that, so everything through benefit access. Just know that if you are uncomfortable using the technology, we have a retirement team that is available to you to help you go through your elections. When we do one-on-one benefit education consultations, as we're getting closer to retirement, we'll also go back out to benefit access and walk through those screens so that people are comfortable with what they are seeing. And it is easy to use. You'll see, again, in the demonstration that everything's presented quite cleanly to you, and then you can see modifications in real time in terms of elections that you may be considering making. You want to register when you can. For those who anticipate receiving benefits come July 1st, okay, we're going to talk about July 1st. It's a Saturday. We got the 4th of July holiday, but you need to make your elections by June 30th, 3 o'clock Central Time. We're in Eastern time zone, 4 o'clock. It's when the market closes on June 30th. You're going to see a pending file. Anything that's in this pending file will get picked up, swept, and processed to generate your benefits for you. Any annuity elections that you have made are irrevocable once we go ahead and process them the night of June 30th into July 1st. So you just want to make sure you have that in good order by June 30th. And what you'll see is if you make elections in May and things change, you can go to this pending file, cancel that transaction, and either defer to another time or just come in with another form of transaction or another form of benefit option that you have. You also want to take a look at your UMPIP, United Methodist Personal Investment Plans. That is, although it'll accept employer contributions, really the driver here is your personal contributions. You would like to know what is your balance in the UMPIP. How much are you contributing? You can see that on benefit access as well as your statements. When was the last time you may have changed this? Now we're dealing with the retiree class, so there may not be some changes, but you never know. Some people may say, I'm going to download a lot of money into this UMPIP over the next 3 or 4 months just to kind of give it a boost before I go into retirement, and you're able to do that as well. You want to understand all of your sources of retirement income. What about other plans? You have the Clergy Retirement Security Program, the Ministerial Pension Plan, the Pre-82 Plan. So you have the UMPIP, your Personal Investment Plan, then you also have the Clergy Retirement Security Program, the Ministerial Pension Plan, Pre-82, if you have Pre-82 tenure, that you'll be generating a benefit from. But we've kind of expanded kind of our thinking in this too. When we talk about other retirement plans, well, you also, I think for the most part, will be receiving your Social Security benefit. We recommend that you go to my Social Security account at ssa.gov and set up your account with the Social Security Administration. Similar to the benefit access registration, there is a registration process. This one's a little bit more intense because it's your Social Security number and all of that that's involved. So here you probably want to give yourself more like 15 minutes of quiet time. They really will come back to you and say, you know, in 1974, which of these 4 houses was your address? 1986, which of these 4 cars did you own? So you want to give yourself time for that. But you create that, and then you can see, and you can generate some paperwork if you like to, but you can see what your estimated Social Security benefit will be. We don't really get into life insurance here, but it's good to understand your life insurance needs and benefits if something happens to one or the other tragically going into retirement or early in retirement. You know, how will that affect the longer term stream of income to be received? And then this is also where we will talk about going out to EY Financial Planning Services. There are several reasons why we would go to the planner line. You know, how much can I afford for housing in retirement? You're thinking about housing in retirement, you're thinking about a down payment, you may use some of your account balances as a part of that. EY can walk you through all of that. What is the impact to my income? What is that going to look like? The choices that I'm going to be making for my benefits, then my Social Security, but also your spousal benefits. If your spouse has a 401k or a pension coming from somewhere else, they'll comprehensively put all of that together and run you some more sophisticated modeling than we can do. What's the impact on this annual cost of living adjustment? Should I go for a higher one now, getting less in the short term, but over time getting more because of the compounding of that higher COLA percentage? And you'll see this visually as we go through the presentation. Again, you want a down payment for housing and whether or not you want to take advantage of the loan feature that we also provide in retirement that you actually have now in the UMPIP while you are in ministry. With the checklist, you want to check in with your annual conference. You want to notify your Board of Ordained Ministry within 120 days. You want to notify your bishop, notify your cabinet. And then again, you know, as you'll hear throughout, interface with or get involved with EY. So although we really haven't gotten into any meat and potatoes yet, and we're going to start talking about the retirement plan, Cheryl, did anything come up for a question or, you know, just the flow of the presentation maybe or anything like that?
So as of right now, everything is flowing well.
Okay, no questions?
There's been no question. I would want to reiterate that the EY financial planning, even though it's not free, where it is free to everyone. It is not a free service, but that is such a great program that would be very useful for everyone to utilize if they can.
Yes, and we'll be hearing more about that as we go along. And what you'll hear about is this thing called operating expenses of our investment funds pays for the overhead, and that's what carries the cost of EYs. So we all pay for it through that dynamic, but there's no out-of-pocket expenses to us individually. So now we can talk about income and where it will come from. This is an illustration of the retirement plans that we have. We have the Clergy Retirement Security Program. We have two time frames with the CRSP. We have the 2007 to 2013 time frame, and then the 2014 plus. For today's purposes, and considering it is retirement 7/1/23 tends to be the focus, that's what we'll do. We will use 7/1/2023. So and when I get to the years of service component that I talked about earlier, you'll see how that ties into both the 07 to 13 and the 14 plus. Then we'll also talk about the ministerial pension plan, the employer provided plan that was in place before the CRSP came along, and then also the pre-82 plan, the plan that was in place before the ministerial pension plan came along. So we will go through those various plans, the benefits and the options that are available to you. And then we'll also go back to the UMPIP, kind of remind everybody of what the UMPIP is, and then speak to benefit options that are available there as well. So we'll begin with the Clergy Retirement, this Clergy Retirement Security Program. This is a very interesting retirement arrangement, and it's actually two retirement arrangements baked into one. On the left-hand side there, you can see there is a defined benefit, or DB feature. It is a formula benefit that we're going to go through. It's more like a traditional pension. This part is not exposed to any market activity. The math is the math. The annuity election, the COLA elections are what they are. We generate an annuity. But then on the right-hand side, we have the supplemental employer retirement account, the CRSP DC, or defined contribution amount. And that is where all employers automatically 2% required non-matching contribution into the CRSP DC. And for those contributing into UMPIP, you get the additional 1% matching contribution for a total of 3% that goes into that account. We will look at the defined benefit component first. It is more involved, not highly complex, but you certainly want to make sure that you understand the annuity options and the COLA percentage options that you have, because once you start to go into pay status with the annuity, those decisions are not revocable. As I indicated, what's there June 30th for CRSP or MPP annuity elections, you go into July or August, say, oh, you know what? I think I made a mistake. It's going to be too late at that stage. So we want to make sure we go through this kind of slowly, methodically, to the extent we can. But again, this is not a one and done type of thing. You'll have more resources available to you, individual benefit education consultations, as well as generic retirement webinars that we are planning in May. I'm going to say May 4th and 6th, but don't hold to that. The defined benefit is not a balance, it is a formula plan. We first multiply 3 factors together. So we're looking at 3 different factors, doing the multiplication, and then annuitizing off of that. The first is what we call the average, the nominational average compensation, DAC or DAC. And the words kind of tell us what's going on here. We look at it all full-time appointed clergy and sum up the compensation, and they get that number that we just used, and we come up with an average. And you're going to see that number momentarily, and we always go a year or 2 in advance so that we know what that number is going to be. But the DAC, DAC, the nominational average compensation. We multiply that by a retirement factor. This is where I'll first introduce the fact that when the CRSP first came along, and for 2007, the retirement factor was 1.25%. General Conference of 2012 reduced it to 1% effective 1/1/2014. So that's why you see 07 to 13 and then 2014 plus, because in the formula that retirement factor is different. And then we multiply it by your credited years of service during that time period. So again, having that clergy service record as you want it to be is important as it generates these CRSP DB benefits. The DAC, or denominational average compensation, for this year, again, we're looking at full-time appointments, is $76,221. We already know for next year, like I said, we go up a year in advance, and that's $78,292. This gets calculated every year. However, in front of General Conference, now 2024, we have a proposal that says, let's just raise it 2% per year and not have to go through this calculation going forward. We will see how that plays out. As far as the factor is concerned, that 1.25% was the initial retirement factor from 07 to 13, and then effective January 1st, 2014, it became 1%. For the assumed full-time appointed clergy persons retiring 7/1/2023, 2007 to 2013, that's 7 years of service. And then the 2014 plus, as I indicated, we're just going to roll it to 7/1/2023 for today's purposes, and that's 9.5 years. So we have the variables, so we have the factors that we're using to multiply and determine the amount. You can see that we have 2000, and we have two columns here. One is for the first tranche, 2007 to 2013. We have the 1.25% to 7 years. We know what the DAC is. We come up with an amount. We divide by 12. We come up with a monthly amount. Then on the right-hand side, we're now in that 2014 plus scenario. It's 9.5 years. The DAC is the same. The retirement factor is 1%. Come up with an amount, divide by 12. And we have an additional amount. So the 07 to 13 amount calculated, the 14 plus amount calculated, and then we add them together. But we're not necessarily done yet, because certain things will impact the amount that you will receive. And these things are based on decisions that you will make. We'll go through them soon. So the surviving spouse benefit. You're married, there's a surviving spouse benefit. You're going to hear there are 3 options for a life and survivorship annuity. And then we also have the cost of living adjustment. For the CRSP, it has to be at least 2%, but the COLA can be 2, 3, 4, or 5%. So what's the impact on a higher COLA going to be to the initial benefit? And then also those who are receiving benefits under the early retirement provision of the Book of Discipline. So I'm going to take a few moments to talk about the early retirement provision. The way this works is normal retirement, I'm going to try to keep it simple. Normal retirement, age 65. Someone's going to retire under the early retirement, age 63. They're not 65 for normal retirement. They don't have 40 years of service for normal retirement, so it's going to be early retirement. It's a 2-year period there. For each month of early retirement, there's a 0.01% reduction in the amount of benefits that you will receive. So that comes to 12% per year. I'm sorry, 6% per year, and for the 2-year period, it is a 12% reduction in the amount of benefits, okay? So 0.01% becomes 6% on an annualized basis. For the simplicity of the model here, it's 2 years, 12%, and you can see the reduction in that amount goes to $1,020. Now, there's no right or wrong answer to when you elect benefits under early retirement, normal retirement, or anything like that. But what I will share with you is, if you're age 63 going into early retirement, but you can wait on receiving your CRSP DB until you attain age 65, you can do so and then begin to receive your benefits. You won't experience that reduction in the benefit if you do defer until that time, but the calculated amount is still as of that age 63 retirement. So we're not counting credited years of service anymore. The DAC for that year is still the DAC that's going to be used that year, and it's either the 1.25% or 1%. Some individuals see the difference between the two annuity amounts as de minimis, and some see it as more robust. Again, that's an individual type of thing to determine how and when you want to receive the benefits through early retirement. If you take early retirement and defer, you don't have to wait till you're 65. If circumstances change, you want to go grab that, you can, and we'll just do that reduction calculation as it goes. And another thing to think about with this reduction that goes through is you're actually getting it for a longer period of time. So it's not really taking anything away. It's just actuarially speaking, we reduce the amount for that extended period of time. That's the CRSPDB feature, and then we have this defined contribution amount. And as I indicated, it is an amount of supplemental employer contributions, 2% non-matching, and then 1% for those in UMPIP that does that. You direct your investments. You can self-manage using the Wespath family funds, how you want these accounts allocated, or you can use Life Stage Investment Management, the program where we tailor and continue on a glide path. We tailor the investment allocation for you over time. As we age up, the amount of the equity side, the bond side, the equity side, the company stock side comes down, the bond side goes up, the income side goes up, and we do that all the way up to, into, and through retirement. It will be made available to you as cash distributions if you so need and so choose. You can roll it over to UMPIP or other retirement plan. Actually, it does go into UMPIP upon retirement, but it is open to you as a portable account that if you want to roll it over to another investment vehicle, another retirement plan. What we will say here is, you'll hear about this later, again, no right or wrong answer, but if you are rolling it out of Wespath to somewhere else, or if you're taking a big chunk of that cash to use, and again, for very good reasons, then that amount will not be available not only for retirement income out of Wespath, but the housing allowance tax exclusion advantage that you have. So you want to make sure you're thinking through what the impact of the tax efficiencies that you receive from Wespath being in our church pension plan, opposed to going to like a Fidelity or a T. Rowe Price vehicle, which could be great, but without the tax advantage of housing allowance. There are required minimum distributions. The Secure 2.0 Act that passed the end of last year lifted that amount from age 72 to 73. And I think at some point in time, it'll actually lift to 75. But for today's purposes, we're just going to use the new age 73. And remaining balances of your account balances will go to your named designated beneficiaries upon your death, you and your spouse's death. That will go to named designated beneficiaries. And so that is the CRSPDC. We have the defined benefit, formula benefit, not exposed to market activity, generate the amount, annuitize it. We're going to go, when we get to MPP, we'll go through the annuity options and the COLA options. Then the CRSP DC, a supplemental account balance. It'll end up in UMPIP for you to choose when, how, and how much retirement income you want to derive from that. So now I'll pause because there's a lot there already, and we've got more to come. So Cheryl, if there's anything that has come into the question box before I go into MPP, please share that with the group.
So no other questions have come through. I think you're doing a great job explaining everything. I know that CRSP can be kind of difficult because it's two different parts, as you mentioned, in one. So it's nice to have that as a feature, but having that as a included with their lifetime annuity, plus then amount that you can actually put into your UMPIP afterwards. So it's a great plan. A lot of people are going to have that as an option, so that's wonderful. So it's just a great job explaining all of that, and we'll look forward to getting into your MPP now.
All right, so ministerial pension plan. What is MPP right now? It is an account balance plan. Again, before the Clergy Retirement Security Program became the active employer-provided retirement arrangement, the ministerial pension plan was the plan, an account balance plan. Back then, 11 or 12%, I think it was biannual conference, 11 or 12% of your compensation went into an account in your name, invested. How is it invested? It's invested using life stage investment management, a subset of the Wespath family of funds that is used to make sure we are tailoring your investment allocation of these accounts to get you to, into, and through retirement with the employer-provided retirement income benefit that was planned for you. So we're using that life stage investment management program. It's all baked in there. I can show it to you on the benefit access demo where you can see how those are allocated. For this plan, the allocation through life stage investment management is more conservative than your CRISP DC or your UMPIP. But again, you can see that on benefit access. And then what does it become in retirement? Well, I'm glad you asked. You go into retirement, you're going to make your elections to receive your MPP benefits. 65% of that amount will go and purchase or buy an annuity. Well, again, this is the area where we're going to start going through the annuities. 65% goes and becomes an annuity. And what is an annuity? Simply a series of payments. For our purpose, a series of monthly payments that will come to you for your lifetime if you are married, you and your spouse's lifetime. But then there's the rest. There's that 35%. Well, that remains an account balance. And that's an account balance for you, again, to determine how, when, and how much retirement income you want to receive. The CRISP DC, we already have it baked into the plan design to do the rollover to UMPIP. Here, very simply on benefit access, you'll tell us to roll it into UMPIP. And we really recommend that you do so because there's no takeaway to do so. It's your account balance as it's invested. But within the UMPIP, that's really where the flexibility of your benefit options with your account balances truly live. 35% MPP and MPP, you can either take none or all. But once you move it into UMPIP, then you have the flexibility to determine how much you want to receive. With the 65%, there are the annuity options, and then there is that annual cost of living adjustment option also available to you. So now we're going to start to look at the annuities. All of the annuity types are provided to you as lifetime income, and if elected, can continue to your surviving spouse. You and your spouse cannot outlive this benefit. It will pay until you pass. The COLA percentage you elect will be provided all the way through. But note here, with the lifetime income through the annuity feature of the plans, once both of you are gone, there's no further benefit paid to anyone else. Account balances, designated beneficiary, here, lifetime income. Same if you are single, and we're going to go through some single options as well. So here's a model, a demonstration of what the annuity may look like depending upon the options chosen. We did actually take a number and run it through all of the, I can't remember what the number was, 300,000, 400,000, ran it through to generate these amount of annuities. On the left-hand side, you can see the three type of life and survivorship annuity options available to you. Starting at the bottom, we have the life and 70% annuity option. I start there because that's considered to be the normal form of benefit. It's not a required form of benefit. You have the other two options available to you, but somewhere in the neighborhood of 70 to 75% of our participants choose this option. And what you can see is you get an amount for yourself as the clergy person going into retirement, and then if you pass before your spouse, then your spouse would receive 70% of that. So the 913 becomes 639. That 913 is the highest of the three amounts that you see in that middle column. If you choose a life and 85% annuity, you can see there's a reduction in the amount that you receive, but there's an increase in the amount that your surviving spouse would receive. If you decided to go life and 100, you both receive the same. You pass, the same amount is going to be provided to the spouse. And you can see The higher the surviving percentage you choose, the lower the initial amount to you, but the higher the surviving spouse would receive. So again, financial planning, your own advisor, EY, retirement income planning, and even the tax efficiency planning can all come into determination of what type or form of annuity do you want to receive. You can elect one form of annuity for your CRSP-DB and choose another form of an annuity for your MPP. It's not one is done for both plans. And the same thing you'll hear about with the COLA percentage. Now, we do have 3 single life annuities for those who are unmarried, looking to receive benefits. And here you can see there are, again, 3 options for a single life annuity option, okay? The first is up on the top there. There is the life only. Single life annuity, there's no beneficiary to receive any benefits upon an early passing, which I'll get to momentarily. This lifetime annuity will be provided to the individual. The COLA percentage will be applied. And once that individual passes, no further benefit to anyone. But let's say we have someone who is single, but there's someone in their family that they're looking after in some way, shape, or form. Could be a niece or a nephew that's going to college where you're helping to supplement the cost of that college, or there could be some sort of maybe future medical issue that you want to start to kind of mitigate some risk against if something was to happen to you and this other individual could continue to receive some benefit. So what you see is a life with 5 years certain and life with 10-year certain single life annuity options. So what this means is you go into retirement, okay, and you start receiving your payment, and you take that 5-year life certain window, and you pass in the 3rd year. For the remaining 2 years, someone, your designated beneficiary, would receive that benefit. But once the 5 years is up, no further benefit to anyone. 10 years, same thing. You go into a 10-year life certain, year 6 or year 7, you pass away. For the remaining years up to 10 years, that designated beneficiary will receive that annuity until the 10-year window comes up, and then no further benefit to anyone. If you choose the 5-year certain or the 10-year certain and you exceed that time frame, because it's from the point of the first annuity payment, you exceed that time frame and something was to happen, no further benefit to anyone. But again, some options of flexibility that can tie into the individual circumstances that you may have. And another side note is, if you are married, but your financial planning is such that you want to take advantage of a single life annuity, you can take advantage of the single life annuity. However, your spouse needs to sign a waiver and consent form and either have it executed at the annual conference office or notarized. So again, more options. And then we have the COLA percentage. What is the COLA? It is the annual cost of living adjustment. It's the annual increase that you'll receive in your annuity payment. How big is the COLA? Well, for MPP, you can choose 0%, but as I indicated earlier, it has to be at least 2% for the CRSP. You can do 3, 4, or 5% as the COLA options. MPP, you can do 0. Basically, it's a fixed annuity over time, but you get the highest amount, then 2, 3, 4, or 5%. Does that COLA option that you choose impact the benefit amount? Yes, it does. And here is how. So let's say we have a life and 70% annuity with a 2% annual cost of living. So again, this is just a model. It's not based on anybody. We have the numbers on the side. We have the years below, just for modeling purposes. But you come out life and 70, 2% at around $1,700. And then it goes up, 2%, 2%, 2%, 2%. But let's say, for planning purposes and long-term planning purposes, you want to choose a 5% COLA. Well, what you can see here is that the amount that you're going to get as the annuity amount going into retirement is reduced. And again, these numbers are just for modeling purposes, but it goes down to like $1,200. However, 12 or 13 years out, you can see this orange line has now surpassed the amount of income you'll receive if you chose the 2% COLA. So there's a crossover point where you're receiving more benefit in the latter part of your retirement. Again, there's no hard and fast rule, but about 12, 13 years, you can see that crossover. So you get a lower amount, but a higher amount later on. For MPP, you can do a 0%. I think this was in place before the Social Security bridge, the life stage retirement income came along. You get the highest amount going into retirement, but as you can see with that red line, it's a fixed annuity. There's no increase over time. And then here we have, if you wanted to do the 3% or the 4%, you can continue to see there is a reduction from that purple line. That life at 72%, the 2% one is a reduction, but over time, you'll begin to receive more income as you move through your retirement. So again, financial planning, retirement income planning considerations. So to summarize, with MPP, you can leave it on the account now until you attain age 73. 73 is the new required minimum distribution age. You have the annuity and COLA options available to you. You can take the 35% of the account balance and wait on the 65%, and you can roll over that 35% to your UMPIP. So what is that all about? Well, you know, in the environment that we've had the pandemic, and then we've had what happened just, you know, in the early part of 2022 with all the activity in the economy and the war and all of that, the market's cratered. This is an account balance plan. You're in the Wespath funds. So those funds, no matter if they're income or equity, is still going to be going through that ride. So if there's a contraction, you can say, you know what? I'm going to defer receiving my 65% annuity until the markets kind of normalize and get back to their historical trend. And while I'm doing that, you could sit on that 35% and let that just stay until you're more comfortable. Or you could say, you know what, Wespath, I want to take that 35%, I want to roll it into UMPIP because I do need some retirement income to come out of that while I'm waiting to make my election on my MPP annuity. You'll tell us that you'd like the 35%. Again, it's just a checkbox to roll into UMPIP. We recommend it, even if subsequently you decide to roll it over to another retirement plan. It just gives you the flexibility and options to do what it is you would like to do. And there's also other distribution options that we will review. Again, flag, the flag with the rollover to another retirement plan or retirement arrangement is the housing allowance tax exclusion. Can't say with 100% certainty, but I've yet in 20 years of doing this come across a commercial vehicle, IRA, for example, that you can get the housing allowance exclusion from. So talk to your accountant, advisor, EY, and if somebody's telling you they can do that, you want all the documentation that you can receive from that. I'll do the pre-82, Cheryl, and then we can come back to the question box if any have come in, because this should not take very long. The pre-82 is another very interesting plan that we have. We have the CRSP-DB in DC. We have the MPP 65% and 35%. And here we have the pre-82. The pre-82 plan was the plan that was in place prior to MPP. When we look at calculating the amount of benefit out of the pre-82, we actually look at two different calculations. On the right-hand side, formula benefit. In that pre-82 world, years of service, pre-82, and then what we call a past service rate, which we'll look at, and that generates an amount of monthly payment. But we also look at what we call the defined benefit service money. And this is very interesting. It is the account that was funded back when MPP was the active plan in the Wespath funds using life stage investment management, having grown all this time. And we will take those amounts and run it through the annuity algorithm, if you will, to determine the amount of monthly income we can derive for you. And when we do that, we're taking the two calculations, comparing them, and providing you the greater of the two amounts. So here is a simple example for pre-82 benefits. Somebody has 2.5 years of service, has service rate of $601. The multiplication there is 1502, divide by 12, you get $125.20. Excuse me. And then let's just say the account, this DBSM account, is $75,000. We run it through the annuity routine, and we come up with an amount of $2437. Divide that by 12, and we come up with $20308. What do we do then? We look and say, which of the two is greater, and we will provide you with that greater amount. And it'll stay that way, but each year, we go back and do this calculation. And if the 2.5 years times whatever a future past service rate may be, divided by 12, exceeds $203.08, then you would receive the greater of that. And we'd switch you over to that past service rate calculation. Now, I will say the spread between the two is getting larger and larger over time. So I'm not sure how often we see that now and into the future, but still it's something we will always do and provide you the greater of the two calculations that we determine. It's paid for life, it's single life annuity, there's no refund, there's no period certain or anything like that. Once an individual ceases, no further benefit to anyone. It is a life and 70% survivorship annuity for Holston. So again, clergy person passes before the spouse would receive 70% of that, and then when both gone, no further benefit to anyone. And then the spouse has to be the spouse at the time in which the benefit elections were being made, future spouse, if you will. So I think now we're going to be looking at UMPIP. We've gone through MPP and then annuities and the COLA with a little pre-82 on top. So Cheryl, I'm not sure if there's anything that came through the question box, anything I may have misspoke on you want to clarify or elaborate on.
No, there's been no questions that have come in, but honestly, all of the plans that we have that you've all explained them very well. It can be confusing to go through all these different ones that we have, but you've made it very easy to understand. But again, the pre-82 is just for people who have had that service prior to 1982. So I know that may not apply to most, some people on the phone, but again, it can apply to some where that population is dwindling just a little bit, but it's still there. We still have that as an option out there. But all of these plans have been great. But now we're going to go into that voluntary plan of the UMPIP, which Frank will now discuss.
So the United Methodist Personal Investment Plan, UMPIP or UMPIP. We love our acronyms. We love to throw them around, DAC, DAC, UMPIP, UMPIP. What is UMPIP? It is a defined contribution retirement plan. It's technically a 403B retirement plan. The parlance is 401k, 401k. In our world, it's a 403B. The plan can be structured to receive employer or plan sponsor contributions, but primarily we utilize the plan, and we'll talk about that plan in the context of participant-driven contributions going into the UMPIP, and that happens through election, through payroll deduction. You're determining the type of contribution you want to utilize, which we'll talk about next, but also it's now going into Wespath funds. It's being invested at your direction. Now, your direction may be life stage investment management. You may have defaulted into it and you're just happy with that, or you made some options and elections over time. You know your life stage investment management profile. That's there, but we always allow individuals to self-manage their investments. Individuals who understand the markets, maybe like the markets, like following the markets. I mean, I do, but I've been doing this, for decades now, I can say. So I just do have that interest, and as of right now, I am self-managing my accounts. But once I attain age like 62, 63, depending upon what the markets are doing, I'm going to use life stage investment management and let that program take over. So you have options as to how you want to invest and track and trend that investment allocation over time. As a point of recollection, there are 3 personal contribution types available to you. You see that we have the before tax up on top, the after tax, and the Roth. I'm going to go to the after tax next. The before tax is what the words are saying. You have your monthly compensation. You've determined a percentage or dollar amount that you want to put into UMPIP. We always recommend percentages because if you get raises, the higher amount goes in. I know this is a retiree class, but you can share that along the way. But you have that amount that's going in. That will go in before all taxes are taken out, including SECA taxes, and you get actually a higher amount of take-home pay. The Roth account was introduced about 7 years ago. The Roth account is technically an after-tax account. So you have your monthly income, and then all the taxes are taken. But the calculation of the amount is as if you had done it on a before-tax basis. And because of that, and we're putting that money into the plan, but you've kind of front-loaded the taxes on that. and giving that to Treasury, to the IRS. Then the government turns around and says, well, one, it's an after-tax contribution, so the contribution dollar itself can never be taxed again. That's double taxation. But since you've given us the taxes now, any earnings that you receive on that account can be distributed tax-free in retirement. And that is what's called a qualified Roth account. And for a Roth account to be qualified, it's actually pretty simple. First thing is the individual needs to be over age 59 and a half. That's a magic number in the retirement world. You have to be over 59 and a half. And the very first Roth contribution has to have aged up 5 years. Not every contribution or every year's contribution. The very first one ages up 5 years or more. You're over age 59 and a half. You can receive distributions from the Roth account tax-free. Before the Roth account was introduced, and prior to the amounts that you could contribute into the plan really started to get more and more robust, there was the after-tax contribution account. And that was used in the earlier days when the amount that you could put in before tax wasn't that big, but you still had room for more in a given calendar year you wanted to put into a retirement plan for future use. You have that after-tax account available. But again, that's kind of waned over time with the amounts going up. As you can see there, that's pretty big amounts for retirement contributions, and then with the Roth alongside of that. So here you can see what the contribution limits are for the before tax and Roth. It can be individual or combined. It can't be each one is $22,500. So you have that. Those over age 50 can put in $7,500 more in a calendar year. So that gets you to $30,000 for a given calendar year. And admittedly so, there aren't a lot of people out there that may be able to take advantage of this. But for those who have the opportunity to do so, and you have a little bit more space in how much you want to put into a retirement plan in a calendar year, that's where that after-tax contribution can come back in. You're at before tax, you're at Roth, and you maximize it, you have some room left over, you can put that in the after-tax bucket. And that last one is a combined limit. How much is the employer putting in a given year for you for retirement? How much are you? And again, a very large number, granted, but $66,000. We've talked about the 3 personal contribution accounts available to you: before tax, Roth, after tax. There's also the rollovers into UMPIP. You can roll over money from a previous employer and put it in, roll it over in. It can be another 401k plan, another 403b plan, governmental 457 plan. We accept traditional IRAs, not Roth IRAs at this time, but it can be an IRA that you roll over. It's a very simple process. As you're getting into retirement and you're thinking about, okay, you want to consolidate your retirement assets, you work with us. It's actually Cheryl who's on the line with us right now. She is what we call a rollover queen. And she will work with the current current custodian of that retirement account and have it roll over directly into UMPIP. You never see it, you never touch it. It is a non-taxable event. You'll get a 1099-R, then it has a code that says this was a rollover, direct rollover. It's non-taxable. So that is available to you. And again, it's very simple. You don't have to do it before 7/1 of this year. If you got so much going on that you're going to just want to deal with that administratively as a task later on, you can always bring that money in later. Often when we are in a room at a seminar, someone will raise their hand and say, hey, can my spouse roll money into UMPIP? Only if your spouse is themselves a participant in Wespath, another clergy person or a lay employee of a conference or something, can they do that? There's no relationship to Wespath or any derivative, then no, you cannot roll over that money into UMPIP. United Methodist Personal Investment Plan, you have the contribution types available to you. You can roll money over them just very quickly without going into great detail. These are the Wespath funds that are available to you. We presented this in a risk-reward kind of way to lay out the funds for you and just kind of remind you of the dynamic of the different types of funds that you can invest in. You can see we have the Stable Value Fund, and we have the Treasury Inflation Protection Fund. Inflation Protection Fund moves all the way up to the International Equity Fund. Those are our funds. A subset of that is in life stage investment management. The risk and reward, Stable Value Fund, capital preservation. There's not a lot of risk in there. You're only looking to get a market rate of interest rate, like 3%, 4%, that kind of thing. Because of that, the potential return is lower. But as you go up that risk scale, you end up in maybe the multiple asset fund, which is a mix or blend of equities and income securities. Well, there's going to be a higher degree of risk with a higher degree of potential return, okay, historical trend. But at any given time, as we know, it can go the other way. And the most risky fund that we have is the International Equity Fund. That is a fund of other countries, companies, stocks that we put into that fund. It's got the highest rate of risk for various reasons, but the highest rate of potential return. So if you're in life stage investment management, we're managing that for you. If you want to self-manage in retirement, you're still able to do so. And you can start to look back at these funds, at this slide, and then go on to wespath.org to get more information about the various investment funds. As far as distribution options for retired persons, you can take a full lump sum distribution. You can take a partial lump sum distribution. Again, we're not going to have any barriers for you when in retirement with everything in the UMPIP to stop you from taking that money out. We'll just talk about housing allowance and those types of things, but that is available to you. Partial lump sum, you know, the NPP 35%. My understanding it was designed that way to help people transition from parsonage to home ownership or condo ownership or what have you. So that is also available. And then you can get cash installments from your account balances. You could tell us how much you want to receive on a monthly basis and change that at any time. You're doing $1,200 for 2023, you need $1,300 for 2024, or you only need $1,000 for 2024. You can tell us that. Or you can use life stage retirement income. I have a whole series of slides on that where you're asking us to derive the amount of monthly benefits for you. It's not on this slide, but right now in ministry, you have the loan provision available to you. That loan provision is also available to you in retirement. And then at death, any remaining balances will go to your designated beneficiaries. You want them in good working order. You can also defer. You can leave these on account and let them continue to grow, you know, hopefully over time. That's the historical trend. You get that growth over time. Then the IRS steps in and says, okay, this has been tax deferred for a long period of time. We need to start generating some tax activity to start coming out of these accounts. And so required minimum distributions have to start being paid. Now, if you're already receiving payments from your plans, you got a stream of income coming through and all of that, you're covered. But if you decided to defer some, including the NPP annuity, and we'll work with you to annuitize that, at age 73 now under current law, you have to begin to start to receive those distributions. The way the law works is it doesn't have to be in the year that you attain age 73, I think most do, but you can actually begin your RMD, get your first RMD, as long as it's by the April 1st of the year following the year that you turned 73. But note, if you decide to do that, in March of that year, you're going to receive the RMD looking back the year you turn 73, but a second RMD is also going to be due for that calendar year as well. So in that instance, you end up with two, and then there's just the 1 year over year over year. Does apply to your accounts across the board, like I said. But for those plans that maybe you're deferring an annuity, pretty much NPP will work with you to annuitize that, but anything else. And we won't leave you hanging on this. If we see this, we'll start contacting you by email, probably throw something in the mail just to get your attention in case you're unaware that this is coming upon you when you are in the year that you're going to turn 73. And what happens is you're in this RMD environment. The 12/31 market value any given calendar year is what gets captured. The IRS has a table that gets applied. It's a factor table. That market value times that factor table comes up with the amount of the required minimum distribution. So we know that amount for your record, for you, in the very early part of January each year, because the calculation is done against this table with the market value on 12/31 of the year that just passed. So, it's all very comprehensive as far as that is concerned. As far as tax withholding is concerned, for partial or full distributions under law, we have to withhold at least 20%. For the RMDs, it is 10%. But you'll see in the demo for your elections for tax withholding, you can say, I don't want you to withhold anything, and then you got to deal with that on your own. So we'll see that. But in general, these are the rules that we have to follow. If we have no direction, no instruction from anyone, 20%, partial or full distributions, 10% on the RMD. I'm going to go into life stage retirement income, Cheryl, so I will again pause for a moment to see if any questions have come through.
So no questions from the audience, but what I wanted to reiterate also regarding those RMDs, the required minimum distributions, with the Secure Act that came through at the end of last year, if you do go ahead and hold on and not do anything with that money until your RMD time period, the amount that if you didn't take an RMD, the excise tax for that did go down. It was 50% as a tax, and so that was a big factor. But now that amount has gone down. It's gone down to about 25% if you didn't take anything as of when you turn 73. So that's a factor. But again, Wespath keeps track of that information for you. So we will let you know when you're coming up to the RMD age frame or age time frame. So we'll let you know. But that's the reason behind it. It's a great, the UMPIP is a great program, and you're doing a great job explaining everything. So let's talk more about that life stage retirement income.
Okay.
Okay.
Yeah, so what Cheryl was getting at is that you have your regular ordinary income tax. If you didn't take your RMD, you got to pay your ordinary income tax and then a tax penalty on top of that. It was reduced from 50 down to 20 to 25%, but still, that's going to be on top of what you're already doing. So again, we will be, quote unquote, in your face to make sure that does not happen. So we're going to talk about life stage retirement income. The first thing we're going to mention is a reiteration of life stage investment management, because the two programs have to work together. For life stage retirement income to succeed, we need to be managing and tailoring the investment allocations to get us through that retirement time period. So with life stage investment management, it's a personalized investment management tool for your account balances. Once it is set up, it becomes on autopilot. What we do is we look at your age. You can tell us what your risk tolerance is. We'll default you to a moderate risk tolerance if you don't. So it's aggressive, conservative, moderate. And we set up an investment allocation. And then two things are happening within life stage investment management. The first is, as we age up, this is the equity side, this is the fixed income side. So let's say it's 60% in the stock funds, international equity, and the equity funds, and this in our income funds. As we age up, that 60-40 is going to come down. 55-45, 50-50, and over time, not 1 year over the next. Very subtly, we're going to do that. We need the equity to stay in the portfolio because we need the risk and the reward. We need that growth. But we need to increase the amount of income that we have because we're paying out income. So those income funds need to get more robust. So we continue to do that over time, all the way through retirement. But the second thing that we do in the program is we look at you and we said, hey, we want to do 60-40. 4 times a year based on your birthday. So quarterly off of your birthday, we'll look and say, hey, we want this person 60-40. They've gone to 70-30. Well, we need to get that back down to 60 and get this back up to 40. Or it went, 50-50. Well, we need to get this back down to 40 to get this back up to 60. So in doing it that way on a quarterly basis, it's a very healthy way of managing the portfolio. And you get a minor, but still a marginal increase in internal performance of the investment portfolio because we're managing it that way. We're not just saying, all right, 2023, we want you here. 2025, we'll look at you again, and we'll make an adjustment. That's not how this will work. It will be doing both simultaneously. So a very powerful program. So with that, we have that program in place to continue to manage the investment portfolio as we get into life stage retirement income. This is an optional program to help you manage your monthly retirement income from your DC plans. Making an election to not use life stage retirement income going into retirement or using life stage retirement income in retirement is not irrevocable. You can go into life stage retirement income, come out, but not even bother in the first few years. So you know what, it's probably easier to let Wespath do it and go back in. Again, more options and flexibility. We consider your account balance, your age, your survivor's age, and your risk tolerance that you told us. Again, are you conservative, moderate, or aggressive? And then the goal is to provide monthly payments for the participant and the survivor's lifetime. So life stage retirement income is not an annuity like the CRISP DB or the MPP 65%. But in this program, we're applying the principles of an annuity, applying the principles of actuarial mathematics and mortality tables and all that complicated stuff that goes on behind the scenes to come up with an amount that we can give you going into retirement to provide that through retirement with increases over time. And well managed, I'm allowed to say that there's a high probability of success. It will last through your retirement. Again, we're using the life stage investment management tool or program as part of it, and the intent is to give an annual cost of living adjustment as well. But it's not a fixed COLA percentage. The way this works is we have the sophisticated algorithm that I talked about. That's like an annuity-like type of thing. What happens is the algorithm will do what they call stochastic testing. So what they're going to do is they're going to look at the markets and say, what would really, really strong markets over the long haul look like? What would really, really weak markets over the long haul look like? And then we have goalposts. And we kick a field goal between that, and we come up with an amount to get you into retirement. It's called a payment safety zone. And in November of each year, we redo that calculation, determine what we can give you 1 year over the next in terms of an increase. But it is market dependent, right? Markets over time tend to go up, but there are years when the markets don't go up, they go down. So, last year into this year, could there have been a decrease for people receiving their life stage retirement income amount? Not necessarily, because even though the markets weren't great last year, with the payment safety zone that we have, it gives us the latitude to say, you know what, for this year, we can continue to keep the amount the same without an increase, but not necessarily do a decrease. So all of that's happening behind the scenes as we're determining the amount to get you into retirement, and then in November of each year, how to get you more and more over time to help with purchasing power and a hedge against inflation over time. Life stage retirement income, that base that I just reviewed right there, the calculation, the algorithm, the payment safety zone, that's been in place for, 12 years, maybe 10, 12 years. Last year, we introduced 2 new features. These are optional features. You can choose one, you can choose both, you can choose none. It all depends upon your individual circumstance. And we'll go through these. We have the Social Security Bridge, and we have what's called a Longevity Income Protection Deferred Annuity Contract. When I do the BA demo, I will show you the screens that you'll be able to access, on benefit access, to start to do your own modeling around what life stage retirement income may look like if you want to take advantage of these programs. Right, so we have everything in UMPIP. CRISP DC went into UMPIP, that MPP 35% goes in there. You decide how much to include in the life stage retirement income calculation. You have an amount. You don't have to use the entire amount going into life stage retirement income. You can hold to the side up to 20% as you enter the program, as a reserve fund or a fund, a vacation fund, and then just utilize the rest of your account balances in life stage retirement income. If you have that separate account on the side, you can stay with the life stage investment matching, or you can subset that investment allocation and self-manage that if you like. Again, more options and flexibility. We're going to take distributions from the funds. You can always add additional funds to life stage retirement income. That reserve fund you can throw in if you want, or a subsequent rollover can come in as well. And you can go back and forth between using the program or staying in UMPIP and doing your own installment plans. Okay, there's no participant cost with this. Similar to EY, the operating expenses of our investment funds pays the overhead, life stage investment management, life stage retirement income. There's no individual cost or fees associated with using the program. With the Social Security Bridge, it's very interesting. I'm not sure, how many people may know this. No offense, but it's one of those things that some people go, oh, gee, I wasn't aware of that. So right now in the Social Security program, we have a full retirement age. For me, keeping it easy, age 67. I attain age 67, but I continue to, I go into retirement. I have a robust amount of account balances in UMPIP, I could say, you know what? I'm going to defer receiving my Social Security benefit until I attain age 70, and I'm going to use some of my account balances in UMPIP through life stage retirement income to offset the amount that I'm deferring in Social Security. For each year that you defer Social Security from your full retirement age, there is an 8% increase in the amount of Social Security retirement benefits you will receive. In my instance, 67 to 70, that's 3 years. That's 24% increase in the amount from my full retirement age to age 70 that I will receive as Social Security. But that's actually without consideration of any COLAs that are built into the Social Security program. So it's really 24 plus. So I say, you know what? I'm going to take advantage of that continuing increase by deferring. I'm going to pull out, for example, $2,200 additionally per month from my UMPIP accounts to life stage retirement income with all the other income streams that I have, and get me where I need to be on a monthly cash flow, annual cash flow basis. And then when I attain age 70, I'd be receiving my Social Security. You notify us of that. We're no longer taking that additional $2,200 out. We reduce or level down the amount that's coming out of your account balances over time to maintain that sustainability of your stream of income over the course of your retirement. I have a visual that will help kind of go through that as well. And then we have the longevity income protection contract. It's a deferred annuity contract that you purchase at the time you're going into retirement. So 7/1/2023, if you so choose to have this longevity income protection annuity contract, you'll purchase it now. However, it begins to pay at your age 80. So you're getting the contract now. It's a deferred annuity contract. It's a fixed annuity, but you know it's going to come at you as guaranteed, additional guaranteed stream of income when you attain age 80. And working with Benefit Access, you can kind of model how much may be available to you to take advantage of this. It will provide a steady stream of income. It is a life and 70% survivorship annuity. So you're at age 80, 85, you pass away, the spouse is still around, they will get 70% of that. And it's based, the annuity is based on group insurance rates. So what that means is it suppresses the amount of fees that are associated with getting that. We're working that as a group insurance arrangement with Pacific Life, as a matter of fact. So it's getting a lot of information is kind of getting put at you with this life stage retirement income. So maybe a visual will help out a little bit better. You go into retirement. You decide you're going to defer receiving your Social Security until age 70. We're using your life stage investment or your UMPIP account balances through life stage to get you the amount of income that you want per month. But then at age 70, your Social Security comes in. And even though it's kind of flat in the visual, it's really kind of like that because you're getting that increase over time. You can also see that we're reducing the amount that's coming out of your account balances through life stage. Then you've decided you wanted to get that deferred annuity contract, that longevity income protection contract. Age 80 comes along and it begins to pay. So we have the Social Security amount. We now have the longevity income protection contract, keeping you kind of where you are, with that new contract. We can reduce down the amount that's coming out of your account balances, so level it off again, so we can maintain that sustainability of providing income to you and your spouse through your retirement. So that is how life stage retirement income is structured. A base amount of monthly installments. It uses life stage investment management to manage the portfolio as you're getting your income. You can not use Social Security Bridge or do the Social Security Bridge. You can do the longevity income protection contract or not. Now, there's going to be some variables on the individual basis that may decide whether or not that's available to you. For example, if you're already receiving Social Security, then the Social Security Bridge would not be available to you. So, again, as you go through the individual type thing, you have EY, you have BE consultations to kind of help you think it all through. Is this program right for you? Well, it may or may not be. If the family history is such that there's not a lot of longevity, then maybe you want the most amount of income that you can get right now, including your Social Security, and just kind of keep everything as it is. or you know you have longevity, and then you can start to do some of this deferral and take advantage of some of these programs in there. Did you opt out of Social Security? If so, the bridge is not available, or you already passed Social Security age, or receiving Social Security, it may not be available. And then, there's other annuity income that you can also consider. You can consider rolling over other income from the outside to put into UMPIP to take advantage of this program and the accounts. And there is an advanced online modeling tool that I will be showing you with you. I'll do the best I can to kind of illustrate, how that will work and how that will look. You should have access to that now. We have your intents to retire date on the system. We certainly have your eligible to retire date. So you may have already seen it, but you can start to do that modeling yourself, and then your particular individual situation becomes more apparent, right? So the goals of all of this: optimize your retirement income. Structure this in a way that you're getting what you can and what you want out of all of these accounts, with all of these streams of income, with these programs to last you through retirement. It minimizes the effect of market fluctuations on your monthly income over time, not initially, but over time, when that Social Security gets laid on top, and then that longevity income protection contract guaranteed income gets laid on top. We're leveling off the amount that's in the UMPIP accounts, still managing it through life stage investment management, but again, having more sustainability over time. And because of that, we minimize the risk of you outliving your funds. So very comprehensive program. The material has been provided to you. I think it's also on the sidebar. And again, this is something that you're going to want to go through several times, just so you can get a real good handle and understanding on how long this will tie together. This gets back to creating a Social Security account, at ssa.gov. Go get, start register, sign yourself up. You can start taking a look at what the projected or estimated or maybe actual Social Security is going to be for you, and you can determine if you want to go ahead and take the Social Security, or take that amount, tell us to take it out of your account balances while you're deferring and getting that increase until age 70. You can also, that life stage investment management profile, I want to look at that. Moderate, aggressive, conservative, you want to see where you are with that, and certainly over time you may grow more conservative, but that's not an absolute. And it's really all ties together, understanding all of your streams of retirement income. Another shout out to go to EY or your own advisor to really do more sophisticated modeling as to how that would work. And anything that you want to roll over, contact Retirement Services, and we can provide support for you. And again, it's actually in the person of Cheryl, who is joining us today. So I'll pause again before we start to get into some other topical type things. We've actually done very well for time. But we still have some things to get through before we take a quick break and then switch on over to the benefit access demo. So, Cheryl, if there's anything to review or be reviewed, please share.
All right, so you're doing a great job explaining everything, so much that no one seems to want to ask a question, but make sure that you have that as an option out there. Please feel free to put any of your questions out there in that questions box. But to reiterate, this life stage retirement income plan, it's revolutionary. It's actually award-winning through us, through Wespath. So it's a very good type of plan. Very interesting and can be very worthwhile for a lot of people if it's right for you. Again, Frank had mentioned about, if you have any rollovers, it definitely, feel free to contact me. I am, as we said, the rollover queen. So feel free to contact me with any questions you may have and to move that money over. And so it's in one area for you.
Absolutely. And I know a lot of people say you don't want to weigh eggs in one basket and all that. And in a general sense, I certainly agree with all that. But I just do think with retirement accounts, wherever they are in the present tense, they're kind of being looked after and kind of tended to, and you're more, I think, engaged with that. For prior employers, they have no obligation to continue to manage that account. It's going to be there. They're not going to do anything with it. But I just think from an ongoing, day-to-day basis kind of thing, rolling all that together. You have other assets that are out there that you're not all putting into that one basket. But my personal thinking, and it's just personal thinking, is consolidating everything there. So we'll move along to the housing allowance exclusion. The housing allowance exclusion is available to clergy in retirement. It's similar and a bit different than how it works through charge conference and whether it's a parsonage involved or residents involved in all of that. So it's just specifically to in retirement appointment. You have to determine, you have to get 3 numbers. You have to generate 3 numbers to determine which you can use for your housing allowance at any given calendar year. Okay, and it's the lowest or the least of the 3 numbers that you generate is what you're allowed to use in a given calendar year. The first number is, hey, what did you get from Wespath as retirement income? You'll know that because in January of a year, we're going to provide you a tax form 1099-R or for rollover that looks back at the year that just passed and says, this is the amount that you received from Wespath. The second number is your actual housing expenses. So you want to keep good records on this because you want that number to be as north as possible because it's the lowest of the 3 numbers. So it's not just mortgage interest, property taxes, or the rent that you pay. Rent is, insurance on your belongings, utilities and all of that. It's also cleaning products. You go to Walmart, you get fantastic. Keep the receipt, put it on your Excel spreadsheet. Tennessee, maybe not a lot of snow removal, but certainly landscaping and snow removal. All of that can be applied to your housing allowance actual amount. So keep good records with that. And then the third number is if you own your residence, what is the fair rental value of that residence, fully furnished, plus utilities in the neighborhood that you live? So it's a market modeling comparison that the IRS has you do. Here we recommend go to a local realtor. You may know one could be in your congregation. Get what they call a comp letter, comparison letter. And then you'll know what you could rent your home for in that calendar year. You want to do it each year because rents do go up, okay? So mostly they go up. So you just want to make sure you're using a good number. But now you have, what did you get from Wespath? What's your actual housing expenses? What's the fair rental value of your residence? And it's the lowest or the least of these 3 numbers is what you can use to take right off the top of your household income, exempt from taxes, and the remainder goes into your tax filing season with other exclusions, deductions, credits, etc., that are available to you in the tax code. What's good news about this is you actually don't have to do anything relative to declaring it eligible for the housing allowance exclusion. Your annual conference, in the annual journal, has language that says in the next calendar year, whatever our retirees receive from Wespath as income in retirement is eligible for the housing allowance exclusion. So my recommendation is the first year you go into retirement, just find that resolution, put it into a folder. Other than that, it's going to happen year over year. Housing always has to be declared in advance. It's declared at your annual conference for the next or subsequent calendar year. So all that is in good order. Here's an example. You received $24,000 from Wespath as income. You spent $20,000 on your house. You can rent it for the calendar year at $21,000. It's the lowest or the least that is available. So $20,000 gets used in this simple example, leaving $4,000 as what's going into the amount that's taxable. Again, doesn't mean it's all taxable. You've got other things going on in the tax code, but that's what you're pushing into the W-2 processing and all of that. Not W-2, 1040 processing and all of that stuff. It's available to retired clergy. It's not applicable to the surviving spouse unless that surviving spouse is also clergy, so it's a clergy couple. On the form that you received, the housing allowance exclusion worksheet, on the back, I think it's the 4th paragraph, we give an example of what you should just put onto your 1040 every year, where it indicates you're taking advantage of the housing allowance exclusion in that calendar year. It's just good to have if somebody looks at it, does it make sense to them, they can see what's happening and move along. And again, it's in your conference journal each year. For those eligible to receive death benefits for the comprehensive protection plan, while you're still in active ministry, there is still the active death benefit. So this is another area where the denominational average compensation, or DAC, comes into play. We'll look at the categorization on the left-hand side, okay, under provision. So you have the clergy person. The clergy person passes away, that $50,000 will go to the spouse. If the spouse passes before the clergy person, then 20% of that year's DAC will go to the clergy person as a death benefit. In the instance where the clergy person passed away the spouse got the $50,000, but then subsequently, the years down the road, that surviving spouse passes away, 15% of the denominational average compensation will be provided to the surviving spouse's named designated beneficiaries. And in the sad, unfortunate instance where a eligible child, you'd have to look into that, but eligible child passes away, then a 10% of the DAC could be provided to either the clergy person or surviving spouse, depending upon what's happening in the household at that time. But that is how that is laid out. For the death benefit in retirement, for eligibility for the death benefit, you have to receive the benefit from CRSP at the time of retirement, and you're enrolled in the CPP for 12 of the last 15 years, or you have active participation in CPP for 25 years. Again, years of service, how that's going to play into this. But moving forward, an individual is eligible based on this criteria, and they now have a retiree death benefit amount. So the words have changed a little bit, but it's kind of the same thing. You have the retiree, clergy person, passes away, then that flat amount that you see that at 2808 would go to the surviving or retiree spouse. A retiree spouse passes before the clergy person or retiree, that 15606 will be provided. Clergy person passes away, you have the surviving spouse, subsequently the surviving spouse passes away. You can see the flat amount there that would be provided as a benefit, the named designated beneficiaries. And again, if there's an eligible child and it's an unfortunate circumstance, there is a benefit that will be provided from CPP in that instance to either the clergy person, retiree, or surviving spouse, retiree, depending upon what's happening in the household at that time. These numbers are designed to go up periodically. It's actually tied into general conference where they go up, I believe, 2% each general conference. There may have been an adjustment through the pandemic, but these numbers kind of fixed until general conference. We do have a provision in front of general conference. Don't know how it's going to go, but instead of having to wait every 4 years, just increase that amount 2% per year going forward in perpetuity. So we'll see if that passes, but these are the numbers that are available as a death benefit now. And I believe in your kit, you also got a sheet that explains all of this too. I'm sure you're kind of interested, it may have crossed your mind as you've gone through this material, when do you start to receive your benefits? So the initial benefit, okay, June 30th comes along, we pick up everything that you have, we then start processing it. And we will start to send that by EFT, electronic fund transfers, a direct deposit into the bank account, either checking or savings, that you're going to tell us about and you're going to update on the benefit access system when you're making your benefit elections. Okay, so we're going to have that automatically wired or transferred in or directly deposited into your account. Now, July is always kind of funny because it's, it's where we are, July 1st retirees. This year, July 1st is a Saturday. July 4th is a Tuesday, that leaves Monday to July 3rd. So the whole process has got to be gone through. It's obviously a huge activity event for the year. Everything gets looked at and reconciled and make sure it's good and clean, and then all of that will get processed. So that initial deposit, Friday the 7th, don't hold me to it, but that's probably going to be around when it will be. But just know that going forward thereafter, that the first business day of each month, your lifetime income annuities will be deposited into your account. The second business day, and I think I actually have that on the slide, the second business day is your cash installment will go in. If you're self-managing or if you're using LifeSafe Retirement Income, that will go in. So in the beginning of each month thereafter, you will have that amount. It's just, we have to go through the initial process for this year's retiree class, and we're bumping up against the weekend of the 4th of July holiday. So a little patience there, but after that, you'll be all set. Wespath participant resources. We have a ton of participant resources for you. We're just going to highlight a few things for you here. I love the word plethora. We have a plethora of participant resources available to you online and in person. We have our participant solutions area. We have our retirement team. That's all available to you. And one-on-one benefit education consultations as we go through this. We did provide a retirement benefits projection for you. It's not really a forecast. It's just an estimate. There's a lot of assumptions that are built in there, account growth assumptions. The MPP, Life Stage Investment Management, 4% annualized rate of return. Again, we have that one allocated more conservatively. For the CRISP DC UNPIP, it's 7% annualized rate of return. Here, it doesn't matter so much. I just ran them a couple weeks ago to July 1st, but still, if people were thinking of retiring down the road, we'd increase their compensation 2.5%, that DAC 2.5%. We're also making assumptions as to the benefit elections that people are making. So when you look at your benefit projection, you're going to see that, okay, there's a date up there. Well, this says 7/1/27, unfortunately, but 7/1/23. Then you're going to see your lifetime income amounts. Okay, that's the annuities that you're going to receive. You and your spouse. Okay, we assume a life and 70% survivorship annuity with a 2% COLA, or a single life annuity with a 2% COLA. Under the account balances, where we're consolidating, but still reporting separately as we have to, the CRISP DC, the MPP 35%, your UMPIP, we're assuming you're taking advantage of life stage retirement income as the program that will provide for you monthly installments. But you can, on benefit access, you can say you don't want to do that. You want to set up your own thing and see what that looks like. So you're able to model that as well. And then on the bottom there, we have what we call an income replacement ratio. Basically, we're looking at what you're going to receive from Wespath. You get estimated, a lot of assumptions on a monthly basis. Then we look at your compensation. We take 1/12 of that 1 month. We do a quick division, and we come up with an income replacement ratio. That doesn't include Social Security. You can add 33 to 35% just as a back of the envelope kind of thing as you're thinking about it. But that's just Wespath over that. It doesn't include any other household stuff, any spousal benefits that may come from a 401k or a pension or anything like that. Again, good to use EY, good to use your own financial advisor to really kind of consolidate all of this as a household and take a look at what your income, needs, wants, desires, and amounts are going to be. So again, another push for EY, which is actually the next slide. One final thought on this. This is just the cover. The assumptions that we make, the benefit election assumptions, the account growth assumptions, and all of that, your credited years of service on the CRSPDB, that's all on page 2 or page 3 of the document that you received. So you can kind of break that out on your own. For EY, we've talked about them several times. They provide confidential, professional, holistic household financial planning services at no additional cost. As we said earlier, operating expenses pays that as part of the overhead, but there's no out-of-pocket cost for us. There's no limit on the amount of time you can call them or how many hours that you can utilize for them. And people understand that right now the retiree class is most certainly front and center taking advantage of EY financial planning. So please, get in there and start taking advantage of scheduling with them to start to review some of your individual type circumstances. You will be asked to provide to them other investments that you have and life insurance that you have, etc. They're not going to look at that stuff and say, hey, I got something that's better, and then do a sales pitch on it. They're not going to do that. They may weigh in as to what they see relative to it's a good thing or a bad thing, but they're not going to do anything other than that. They're not going to try to sell you anything. They're just going to give you the objective analysis of what they're providing from looking at what you have provided to them. There's their phone number, 800-360-2539, wespath.eynavigate.com. Another place you can go and register, give yourself 5 or 10 minutes, register. They've got a lot of educational materials and a lot of tools that you can use yourself to start to model some of your own income expectations. The benefit education consultations, these one-on-one benefit education consultations, that's benefit educator Todd Creviston there in the photo. These are, you register for 1.5 hour consultations, but it's not a one and done thing. If we haven't gotten through everything, we'll immediately schedule a follow-up, or if subsequently you want to set up a follow-up, you can do so, either going back to the registration link and talking to one of the other ones of us, or just kind of coming back to us offline by email, and we manage the registration link that way and get another consultation up and running. And we've talked about EY, and we talked about the BE consultations, and really what we have found over the 2+ years that we've been doing this is having the one-on-one consultation, do that first, because even though we'll have to stop at certain points, say, I can't give you advice, I can't give you guidance, but then we can flip it around and say, but these are the questions you might want to be asking and thinking about as you prepare yourself for that EY call or meeting that you're going to have. So, and you can come set that up. I'm going to send this registration link to Julie today or Monday, probably Monday with all the recordings. And then you can set that up, but it's probably out there right now if you search for it and wanted to set one up today or over the weekend. far as action plan is concerned, if you haven't registered for benefit access, please do. If you have and you haven't used it in a while, please go out there, start using it, get used to the authentication when we go back to you with a text or a phone call, and we give you a number, you get that back to us, all of that. Review your beneficiary designations. You don't want something tragic to happen to you and your spouse, and you're not in good working order, because then it goes to your estate, which goes to probate court. It take years and fees later before it comes out. It may not come out exactly the way you want it to. No offense to any judge or anything, but they're going to use their best judgment at that time. So keeping them clean and in good order is important. We've talked about the life stage investment management profile, running your own projections, using UI, and our benefit education consultations. We have participant solutions. We have the consultations, benefit access, and then EY. So obviously a lot of redundancy here. What's not here, and it may be bad on my part, I used the wrong slide. There also is a retirement team. They have a dedicated phone number. You have that in your materials already, but certainly you can find out the retirement team phone number from this general participant solutions area itself. So that concludes the deck presentation part for this morning. Cheryl, again, I don't know if anybody has any questions. If any questions come in, I'm coming back on camera. There are you.
So no other questions, but honestly, great information that you've been able to give here. Wonderful, wonderful way of presenting it to help try to make it as easy and to understand as possible. So thank you for that.
Okay, it's 1:41. So why don't we say 150, 150. No, I'm sorry, I got the wrong time. I'm looking at the wrong thing. What time do I have? I'm actually looking at the clock on the presentation. It's 11:45 Eastern time. So let's go with 11:55, so 10 minutes. And then we'll come back, and in the meantime, I'm going to go off camera and I'm going to set up for the BA demo. So we'll go off camera, go on mute, 10 minutes. We'll come back and be ready for a BA demo. Okay?